identifying what are the breakpoints that I want to solve can be a really interesting framing. It can be a really interesting framing to focus on one or two of these core areas and say, this is where I help. Then you know the exact revenue range, you know the exact problem, you can build a repeatable process. So for people out there thinking about that, at Paceto, we're really focused on like 7 to 11, 7 to 12, like the upper end of that, which has also helped. This has really illuminated that companies that are sub 10 million ARR have problems, different problems than what we solve at Paceto, which has been another interesting learning straight from this chart. It's important that you have the proper financial metrics and the proper CRM metrics to really, really evaluate and dig in and identify where this issue is. But as a maturity model or as a diagnosis, this can be a really helpful framework. I got a couple of things that I was preparing that I want to share. There's been some questions in the Q&A that I've answered, but I think some visuals will help sort of like illustrate this a little bit more. So we'll share some visuals. But before we get into that, just like some personal learnings and things like that. It's 12:04 noon Central on August 6th. I can't see exactly because I don't have the mouse, but I think there's like 25 people on this call. 20. So August is a lot of time where a lot of people slow down. In Europe, most people are checked out. Their cultures are different. I see the value in that type of stuff. For the people in America, we don't do it the same way, but a lot of people in America check out for weeks during August, and sometimes I've done that. But the past couple of years, for me, what I've noticed is August is like the time to build all of the momentum into the end of the year while everyone else is off. Maybe it's not sales too, because a lot of people aren't signing contracts in August for whatever reason, but getting your business ready, because once after Labor Day happens, you're in a sprint to the end of the year and it goes by fast. And I think using August to really set you up to propel forward, I think is a strong thing. On a different note, it's the middle of August in Austin, Texas at like 6 p.m. I go for runs every once in a while, multiple times a week. I'm around Lady Bird Lake in here. It's 98 degrees. You're running on the trail doing like 4 or 6 miles. There's literally almost nobody else out on the trail. And I like that. I like doing that thing, knowing that nobody else is going to go out there and do that run for 4 or 6 miles at 6 p.m. when it's 98 degrees. And I found that it relates to a lot in business too. A lot of the reasons that I feel like I've been able to grow is by doing a lot of the shit that nobody else is willing to do. In 2016, like spending 2 a.m. on a Saturday evening on the phone with HubSpot support, trying to figure out a new use case that they've never used their tool before while my friends are out getting drunk. Spending most Sundays when I was building my first company, Refine Labs, spending most Sundays working, and my weekend was going to the beach for 2 hours during the summer on a Sunday. But other than that, 7 days a week, like grinding it out. And I'm not over here telling you to work 100 hours a week or do things like that, but I am communicating that if you're in a place where you think you got it or you're trying to get ahead, then doing some of the things that other people aren't willing to do is one of the main ways to make that leap. That's just a little bit of note. Shout out to all of you here that it's the middle of August. You're still on here learning and doing those things. So shout out to all of you. We're going to share a couple of slides right now. These 2 concepts have been published by Winning by Design and Bench Sites and some of the people in those firms. And I want to like shout out to the work that they're doing here. The revenue factory concept. I've been talking about the concept of, supply chain in a way to look at marketing and how it impacts it like a factory since 2021. And they've really put all of the structure around it to really make it real. And so I want to share a couple of the things that they've been doing that have resonated with me recently. And one of them answers a direct question that Mason had last week that I answered verbally, but I think having a structure and a visual to it's going to really help. Let's go through those 2 slides right now. For people that are listening to the podcast afterwards, you may want to jump to YouTube so you can see the visuals. The first model that they have here that they put together is the 12 revenue breakpoints to $1 billion ARR. And I think this is incredibly interesting because having, working with many companies simultaneously right now in this range between like maybe 30 million and $1 billion, that these breakpoints and the way that the companies operate are actually very predictable based on the recurring revenue size. And I think that understanding and being able to isolate what is our actual breakpoint right now, why is this slowing down or what's causing it? And I think being able to isolate these, it's very predictable. So let's go through them. Number one is pricing and packaging. This is like right at the beginning. We have to have a business model and a price and a delivery model and an offer so we can get our first couple of customers. Number two is superstar-led growth, founder-led sales, one like VP of sales doing heroics, things like that. You need superstar. You're looking for the superstar marketer to run a campaign to help you hit that quarterly revenue target. So now you're in this like unpredictable artisan level work in the sub 5 million ARR. Then you start to have, as you start to hire some people, you have a data model and structure, which becomes the breakpoint. So is it a lead? What does an actual lead mean? What is a qualified meeting? What does that actually mean? So that when we have 3 or 5 reps doing things, that there's some type of structure around it. Then you have GTM motion, sub 10 million ARR. You're basically attempting to find one go-to-market motion that can get you to 10 million ARR, whether that's no touch or medium touch or like a account-based dedicated touch. Then you get into repeatable process. And all of these things are breakpoints that happen before 10 million ARR. And then what happens as you start to cross over 10 million ARR is that your go-to-market motion in your business runs more like a factory. It runs more like a factory where it's a connection of different processes and people trying to accomplish a goal, which is recurring revenue. And so at that next, you have the growth formula. Like the back in the day, growth formulas would be like, we need 1,000 leads to get a customer. Or if we have 12 SDRs, they make 100 dials a day, then we'll get 6 meetings a day. Or what? Those were the early stage growth formulas in the growth at all costs era that were not efficient and did not deliver. However, companies still ran them because there wasn't the pressure on the unit economics that we've seen in 2023, 2024, and we'll continue to see moving forward. Then you get into this range, probably 20 to 100 million, where there's like this collapse of key revenue breakpoints that happen. Number one is scalability. So the inputs into the factory, we can't grow them enough. Think about like, if you run 100% inbound motion, you're relying on demo requests only, and you only have demo requests, that at some point you're going to hit a point where there's just not enough scalability there. First would be a scalability problem. Then what happens after scalability is a sustainability problem, which many companies face around 50 million ARR, where they've been able to grow the revenue, but at such an inefficient way that they need to figure out how to make it efficient to get from 50 to 100 and further. And then after that, you have scalability. Another scalability metric, which isn't the inputs, but it's the throughput. Throughput is the conversion across these different processes and stages. And then after that, you start getting above 100 million. Then you have other challenges. The first challenge is interoperability. Many people believe that every motion that you add, go-to-market motion, is purely additive, that we'll get everything that we used to get, and then we'll add this motion and we'll get more. The problem is that the interoperability of these motions actually can impact each other and play together. So I'll give you a common example. Company grows to 100 million ARR. In 2022, their investors decide, hey, PLG is hot and cool. We need to implement a PLG motion like HubSpot so that we can get to $1 billion. And so they have their existing medium touch, inbound SDR, AE sort of model going. Maybe they have an enterprise motion as well. And now all of a sudden they add this PLG motion. And then all of the volume metrics that used to come through the medium touch and the enterprise touch start to flow and get diverted into the no touch motion. And it messes up the entire fucking factory. And it can cause some really big problems, specifically adding a PLG motion to an existing already running inbound and enterprise motion can be very dangerous. But to get back to the point, you have interoperability challenges between these different motions, or even you start to break it down by geo or business line and things like that. Next, you have durability, which is effectively a measure of gross revenue retention. At some point, if your GRR is too low, you'll just reach a point of being stagnant. At some point, you have to be able to deliver ongoing recurring impact for a long period of time to improve the CAC to LTV ratio. That usually happens well above 100 million ARR. And then you have consistent profitability, assuming that you IPO somewhere between 500 million and a billion in revenue. And so those are all of the key revenue breakpoints. If you are a consulting firm, an agency, a freelancer that's working to try and get into this space and go-to-market strategy, which I'm now sort of in many cases reframing as go-to-market optimization, identifying what are the breakpoints that I want to solve can be a really interesting framing. It can be a really interesting framing to focus on one or two of these core areas and say, this is where I help. Then you know the exact revenue range, you know the exact problem, you can build a repeatable process. So for people out there thinking about that, at Paceto, we're really focused on like 7 to 11, 7 to 12, like the upper end of that, which has also helped. This has really illuminated that companies that are sub 10 million ARR have different problems than what we solve at Paceto, which has been another interesting learning straight from this chart. Tons of learnings here, tons of things that you can go back and look and try and assess whether you have a client or whether you're working in a company. And being able to assess this, it's important that you have the proper financial metrics and the proper CRM metrics to really, really evaluate and dig in and identify where this issue is. But as a maturity model or as a diagnosis, this can be a really helpful framework. Ongoing to that, I guess we'll talk about the metrics and the financial stack. So we'll go to the next slide because Mason asked a question about this last week, and it kind of goes on. Sorry, it's a little blurry. I took a screenshot out of a book. Again, another model by winning by design, something that I agree with in theory, and now we're sort of modeling and how is this going to work in practice, because a lot of the theory breaks down when you start to make it practical. So we're making adaptations to this, but as a high-level framework, I think this really helps. If you look, you can see the different layers of the metrics. Layer 5 at the top, what the investors, the board, and probably the C-level executive, CEO and CFO are looking at, investor metrics. And then you can see the dotted lines, and the dotted lines then break down, because at the top you have metrics that are basically a combination or calculation of many smaller metrics that create one metric for an investor to look at to say, is this a good investment? Are we on track? Things like that. But they're really a breakdown of many other smaller metrics. And so, for instance, if you have growth rate, you basically have ARR and NRR and contraction and churn. You can make that into the ARR waterfall, and you basically are able to calculate growth rate. And then if you have NRR, you can then break that into existing customers, less churn and contraction. You can keep breaking it down to eventually getting to a place where you have unit economics. And then even further, the go-to-market efficiency. So for instance, the conversion rate between a meeting booked and an opportunity created, or a meeting booked and a qualified opportunity, or an opportunity created and a closed won deal, or the time between a customer signing the contract versus them completing onboarding, or any other step in the process, that you have the time and the volume and the conversion. There's this slice where you see performance metrics, that third layer, that above that, you can calculate everything looking from the accounting system. The finance department can calculate all of those metrics on layer 4 and layer 5. And then layer 3, it breaks down. And then at layer 2, you start getting into CRM metrics. And so if these numbers aren't talking together, you don't have a way to break them down. But if they were joined together and working, then theoretically, you'd be able to say our growth rate is slowing down, break it into the next metric and the next metric and the next metric, and easily isolate what is the biggest problem in our go-to-market that's driving our growth rate down, and then go and fix that. Because all these metrics are just the compounding and rolling up of existing lower level metrics. It also works as an incredible monitoring system to be able to early warning signs. So instead of you seeing, oh, our growth rate is down from 18 to 12% 6 months later, 6 months earlier, you could see, oh, the conversion between this stage and this stage for our highest volume production line or highest volume motion is going down, and predict and stop it from happening 6 months before it shows up in your growth rate number for your investors. And so by building a methodical stack of go-to-market KPIs can help you easily diagnose as a CEO, CFO, or even a revenue leader, be able to diagnose the issue and then go and focus the investments and the priorities in order to resolving that so that you don't see it in the top level metrics. Some things that are required in order to make this happen. Number one, you must combine financial data with CRM data, which is very foreign to go-to-market teams. For go-to-market teams to be able to integrate the financial data. And it's very foreign for financial teams to integrate the CRM data on the other side, but you need to join the two in order for these types of things to be possible. Number two, you need to have a data model inside of your CRM, and you need to have a data model inside of your accounting system that's been able to track expenses, categorize them, tag them, and at the CRM level, be able to track when the meeting was booked, when it was held, when it was qualified, did it close one, how long did it take, what were the steps and the stages. Most companies, while maybe that data is set up and disparate in a bunch of other places, they cannot produce reliable reports on the actual flow of those between the different stages by customer segment or any other slice. So you need a data model in the CRM that brings this together. And then you need somebody that is able to look across the unified set of KPIs. There's an interesting visual if you think about it as a horizontal bow tie, that department level metrics work vertically in one stage of the process. And what go-to-market does is it looks horizontally across the whole process and allows us to find the most important opportunities across the whole process rather than just optimizing inside of our silo. And so that's why I believe that that some combination of finance or people that come from go-to-market and then build the finance chops, those two sets are most well equipped to solve this issue for companies in bringing these two things together, which then makes your ability to hit a CAC target or plan your growth rate or evaluate the risks in your plan. It makes all that stuff way more simple when you have a structured set of KPIs like this. That was an explanation on that part. I think I got a couple more topics, then we'll get into questions. Actually, there was enough presented there. Let's get into questions so we can cover this stuff for people, because I know it's new material. And then if there's ways for me to slide in the other stuff, I will. Otherwise, we'll cover it next week. Yeah, I would love to. This is something that I've been thinking about a lot. If you haven't read the revenue architecture book, I would highly encourage you to do it. Coming from, in my background, the first 5 years of my career, I worked in manufacturing facilities. Let's lose the deck. For the first 5 years of my career, I worked in manufacturing facilities, optimizing supply chain, optimizing processes in a facility, making automation so people could do their jobs better, finding quality controls so we have less defects, like all that stuff, in addition to my engineering background. So this framing of your go-to-market being a revenue factory makes perfect sense to me. And I think for any logical person that reads the book, I think that it would look the same way. And it truly simplifies and unifies the way that we look at this data. And as executives or leaders, not being so caught up in, did SDR source that, or was that meeting booked by, a marketing touch, or how many touches did they have in marketing, or all this other like minutia that people get caught up in. Level up, forget about attribution, calculate core KPIs, and make that the core thing that we're looking at first, and allow attribution and other forms of custom analysis to be the way that we go deeper to figure out what are we going to do about it. But it's to be very clear that it's secondary to core business KPIs.
Love it. There was, we surveyed the chat here to kind of say, okay, what revenue stage or growth, stage are you guys in right now? And most people responded, at least on this call, or at least they're between like a 7 and a 9, unless they're at a very early startup, like Paceto is at, number 2, right?
Mm-hmm.
So I think most people that are on this call, we have one person say 5, but a couple of people said between 7 and 9. That repeatable process, that repeatability and sustainability is kind of a core focus for a lot of people right now.
Totally. Yeah. Love that. Love those insights. So for people that are in the 5 to 10 camp, if you have specific things that you've been thinking about or data you've been looking at, you feel comfortable, let's chat about some of those things.
Danielle has a question. Let me see if I can unmute you.
Just like, what happens if you skip number 2? If you have somebody who's not really, is like that just a leader in the organization who is willing to put themselves out there to lead that growth? Or I think you were alluding to that could just also be like a strong marketer who has really great ideas for a campaign. But like, what do you feel like is the consequence, or the, like, what does that look like in action to have a strong leader in that breakpoint?
Before your 10 million ARR, you should be doing whatever it takes to get to 10 million. And sometimes unit economics are less of a concern because the numbers are small and you've raised enough money and you're going for proof of concept. And so imagine being like less than 10 million ARR where you have like a famous artist that takes like 9 months to make one painting, or takes a long time, or you have a couple of people. You don't need automation. You don't need like a big factory. You have one person that's highly skilled, that's able to get the job done. That when you move to 100 million and you have 100 reps, that level of artistry and that thing doesn't work anymore. If you rely on just the skills of people with no systems and process and data, that is just going to be a total mess. But you can get away with it without systems, process, or data when you're a million ARR and you have one person selling for you who's the founder. So that's just as a comparison. I think that any of the steps aren't necessarily like skipped, but sometimes they can be easier for some companies to pass through than others. And so I think I would look at it more like that. Like somebody's out there getting you your first million ARR, and it's not usually a team of 5 AEs with a process and structure. So it's more so just recognizing that it's part of the process. Yeah.
Okay, we have an anonymous question. They don't want to give too much away from maybe the company that they're at. But here's the question. As a company, we're going back to number one. So number one is pricing and packaging. And we're trying to evolve our offering in a more competitive landscape. As this happens, should we work our way back through these different breakpoints, or because they're kind of going back, could they skip some of these breakpoints?
How big is the company? Let's just drop it in the chat. Employees, revenue range, just so everyone has context.
So pretty small company, around 17 employees.
There's like the textbook answer that I think a lot of people would give you, but I'm not going to give you that one. I've actually like been an entrepreneur and changed pricing and packaging at a company that's doing more than 4 million. So I'll give you my answer. Is that change is not the solution. Addition is. What you don't want to do is take your business that's 17 people, that's doing 4 million in revenue, and change something and fuck the whole thing up, which can happen when you do those things and you make those bets. Instead, keep the $4 million business running and then have a new offer that you consider a beta or experimental or something like that, and go out and find who you think the best customer is and go outbound to them and get 10 customers and prove that it works in the background of you running your $4 million business. I think that is the true answer. Once you have a machine that's running, like there's a difference between optimizing it and then knocking it down and building something new. And when you knock it down and build something new, you're just destroying time and enterprise value that you've already created for your company in a lot of cases. So I would just I would caution you and think more about adding or experimenting with the new offer rather than changing the business you already have.
We got some love in the chat from multiple people based on your real advice versus your textbook answer. So yeah, this person said that's super helpful. Very, very good advice. And another question is, it sounds like you've went through this before. Can you give an example of like when you've done this at your company or previous company?
So a couple of different times where this has happened. So early on at Refine Labs, like 2 million ARR, we had an existing offer that was working. We sold it between $12,500 and $18,000 a month. We sold it to a company less than $100 million in revenue, where we ran their advertising and optimized their CRM, and it required one person on our side to do the work, and we got paid 12 to 18K, and we delivered value to customers and they were happy. And then what we did is most of the companies that were running that struggled with building the creative and the content for the ads, which was the main driver to whether the ads are effective or not. And so we said, hey, customer, now instead of buying this thing that you like and you've already bought, now you have to buy these two things together. And instead of being 12 to 18, it's going to be 25. And what we did is we took something that was already working and we got rid of that offer and made a different offer. And the customer, not every customer wanted the creative, and not every customer like saw that as a key value point. So then they started comparing our 25K retainer that included creative to a commodity agency retainer at 10K a month that didn't include creative, and thinking that we were expensive when it wasn't an apples to apples comparison. And that is an example of a change where we just we took an existing offer and that was working and got rid of it. And in hindsight, I would have gone back and made the addition optional, which seems logical, but sometimes like when you're actually in it making decisions, like in hindsight, it's easy to go back and say, I would have done something different. Everybody does that. It's way easier to see how it happened and then think that you could change it. But in reality, you make the best decisions that you can at the time. And we had other considerations in the business as to why we did it. But that's just like one practical example of how that can happen.
I think that's helpful for the listeners to go through a practical example.
Yeah, that's a pricing and packaging one. Messaging and ICP can be another one. The match of who you're selling to and what you're selling also really matters. And so like at Refine Labs, a lot of like, obviously the existing was through the demand gen or CMO, like that was the flow for, and still is the flow for the Refine Labs content, advertising, demand gen services. But then we tried to inject new services that were revenue operations and finance and things like that through the CMO, and that buyer doesn't care about solving those problems, or at least it's not their top priority, or they don't have budget allocated there. And so all of these new things we tried to bring through, which were the right things for the company, brought through and introduced through the wrong stakeholder. And so that was another key learning for us, especially if you think about cross-sell or product expansion or things like that. Like it's really hard to own like let's say your outreach or sales loft and you sell through head of biz dev or VP of sales or something like that. And then you try to add a email automation sequencer for marketing and bolt that together, but sell it through the VP of sales. Like you have to make sure that your cross-sell or your upsell stuff ideally flows through the same channel that you already actively sell to.
I think we're learning that a little bit here at Paceto of who we sell to and our different motions and who's our ideal buyer. And we're still going through that, which is super interesting to me, and how we craft some of that. Another question that we got from the chat. So a lot of people are kind of in this 7 to 9, which is, scalability, sustainability, and scalability throughput, right? Those kind of core stages, which brings up the go-to-market efficiency. So someone commented on your post this morning about your go-to-market efficiency kind of formula that you talked about on LinkedIn today. Could you go into a little bit more detail of what stage would be best to start tracking that and optimizing for that go-to-market efficiency formula?
I think that like as soon as you have a finance department or investors, your finance department will be calculating it either way. They just might be looking at it in a slightly different way in terms of CAC to LTV or CAC payback. I feel that sales and marketing as a percentage of net new ARR is the most objective calculation. How much did you spend in the last 12 months and how much new revenue, incremental ARR did you get in the last 12 months? It doesn't make you guess how long your customer is going to stay or make an assumption around their expansion profiles or any of that stuff. It takes out all the assumptions and it looks at it objectively. So I think that is the strongest metric. When we say sales and marketing spend, it's total go-to-market expenses, sales headcount, operations, technology and tools, the national sales meeting or the go-to-market kickoff meeting, all the events you do, marketing programs, all customer success, account management, all the stuff that's required to acquire, retain, and expand customers. All those expenses together divided by how much incremental ARR you get gives you go-to-market efficiency. In 2021, public SaaS companies were around 140% would be the median, which means that they spend $1.40 to get $1 back. But now that number is skyrocketed where the median is somewhere around 250%, almost doubling, where now they have to spend $2.50 to get $1. And the low performers in the public SaaS markets are somewhere between 300 and 500%, which means they have to spend $3 to $5 to get $1 in incremental ARR, which means they have a massive sustainability problem. And so that's just the rationale for the calculation and how you look at it. And I think that calculating it, once you have a finance department, some type of calculation like that is going to be calculated. The thing is that we need to be connecting that finance calculation into the go-to-market data and then driving the investments and the strategy with that number in mind and being able to isolate why is the number, if we're at 300%, why is it that way? Where are the places where we're spending a bunch of money and not getting an ROI? That's what it is. And when you're a CFO and you look at, if you allocate $50 million in go-to-market expenses and 13 go to marketing and 6 go to SDRs and this much goes to sales and this much goes to customer success, and then you have the operations and all the other underlying things that go across it, and you allocate that 50 million, you're a portfolio manager. You're an investment advisor for a $50 million portfolio. And if you move $2 million of investments out of this place and you put it over here, then you might get a significantly better return or an incrementally better return on the investment. And that's more or less what it is about allocating it across the go-to-market. So if you have a follow-up, please do. I think using those numbers to try and isolate is the issue. Number 7, number 8, number 9 could be a good next place to go.
No follow-ups on that specifically yet, but maybe if you want to transition
let's
to
just
one
do
of
that.
the other topics.
I'm just going to do the 7, 8, 9, right? So
Okay.
Breakpoint 7 is scalability of inputs. Breakpoint 8 is sustainability, which is a cost efficiency metric. And then Breakpoint 9 is another scalability metric based on throughput. Okay. And so to figure out which of the 3 that you're at, think about what is the problem. Is the problem that I can't get enough of what I need? That's Breakpoint 7. So if your model is number of qualified opportunities to hit a revenue target, or number of leads to hit a revenue target, or meetings booked, whatever your early stage indicator is, if you can't get enough of them to have the theoretical calculation, then you have a Breakpoint 7, you have an inputs problem. Then you get to number 8, which is a logical next step, which is that you start buying enough of the inputs, but when you buy the inputs, the conversion rates go down and the cost goes up and the efficiency goes down, and then the efficiency gets messed up, and then you're in a sustainability problem. Sustainability would show up in sales and marketing percentage of net new ARR. Scalability would show up in growth rate. And then number 9 being scalability of throughput, which means that we've optimized the inputs, we're at an efficient cost. And then if we improve win rate from 18% to 23%, or if we reduce sales cycle, or if we improve our conversion for enterprise accounts, like in that level, then you're in a throughput, which is how do we make what we already have significantly better without introducing new costs, or at least excessive new costs. So that's how you decide between the 3. Number 7 is usually felt before 50 million ARR. Number 8 is definitely felt right around 50 million ARR. And number 9 is felt somewhere between 50 and 100. And then once you get beyond 100, typically, at least in so far of what we've seen, there's some outliers here, but generally efficiency and unit economics are at least in an acceptable range for companies beyond 100 million ARR. And at that point, you're in more of a continuous improvement motion rather than breakthrough or transformational change usually. And so after that, it's about continuously doing things better. But before that, sometimes you do need a transformational change to your marketing strategy or your go-to-market architecture or how you allocate investments. Many times you need a transformational change between 30 and 100 to get to 100.
Yeah, we got some comments in the chat that the breakdown is that you kind of just described between 7 and 9 was really helpful to kind of isolate. Stacy said she's solid at a 9 right now, and then she was not sure if she's at a 7, 8, or 9. So that was super helpful. I will get some other questions going here. I've got some from previous episodes, but if anyone else has any questions on this specific topic or want to go into it a little bit layer deeper, we can bring the visual back up and jump in if we need to.
I'll do a couple because there's been some things floating around.
Great.
Yeah. So on my post today, I was talking about go-to-market efficiency and how I think that the finance department is the one who's going to be solving this. 1, because of their vantage point. 2, because they really feel the problem. And 3, because they're actually objective and sit outside of a functional department that runs the go-to-market. So I think there's a lot of key reasons why. they're well suited to solve it and work with the CMO and the chief revenue officer, and if there's somebody that owns post sale and all the other stakeholders. But I think that finance is well equipped to solve it. And whenever I make some of these like statements around unified go-to-market KPIs and things like that, the first place people go, and it's even come up, and it just comes up on these calls, but it comes up in comments too, of like, so is the first step changing the comp plan? Like, how is that how we're gonna like get this thing done? And I just want to explain the prioritization here and all the things that you can do to make this change and make positive impacts to your business without touching the existing compensation plan. Changing the compensation plan of marketing or SDRs or sales or anyone in your go-to-market organization, especially if done across the whole go-to-market and not just in one individual department, is a massive administrative burden and creates tons of political issues and distracts your organization from the key things that they're out there to do, when many people are totally fine with the way that they're compensated today and the total compensation that they get for their role. And it would be better spent to just adjust their KPIs so that they're working and doing a better job and they're more focused than changing marketing's plan from purely salary to 30% compensation based on some stupid number and having them focus on that. I think that if you want the things that you can do before you try to touch the comp plan, because I think that should be so far away from what we're doing here. I just don't, if you look at all the things that you could do as an executive leadership team, changing the comp plan of your go-to-market team is a way low on the priority list to make an impact on what you're trying to achieve. And so number one is you should be aware and adopt these KPIs at the executive level. You're not going to change how the marketing team is scored or whether the CMO gets their bonus. You're not going to change any of that. Just look and be aware of the KPIs and be aware of the historical trends and get the CFO, the CRO, maybe some of the people in your VP level aware of these metrics, understand how they're calculated, and understand the core trends that are happening in them. Then number two is that you can start to use those KPIs to actually drive some of the strategic decisions that you make across your functional departments. And then number three, your VPs and your directors can then be accountable. Instead of being accountable to a lead target based on some attribution model, they can just be they could be gold on qualified pipeline across the entire go-to-market. You can just shift their KPI without ever changing their compensation plan and just pointing these people in a slightly different direction that's better for the business. And all of that stuff could get done before you adjusted the compensation plans. And so I like to put that out there because I get that question all the time. And if you made a list, if you look at the numbers and you say growth rate, go-to-market efficiency, and free cash flow, those are our objectives. What are the things that we could do to impact those key numbers as an executive team? Changing the go-to-market compensation plans are below hundreds on the list. They are not even close to a top priority of what you could do to move the most important numbers, and for 1 out of 1,000 companies, the comp plan is so messed up that maybe that is the number one thing, but for almost everybody, it's not. And so that's one point. Another thing that I've been trying to get across that I'm trying to do even more is that when we're making investments to create pipeline, the distinction in breaking it out between what SDRs did and what marketing did is just not relevant anymore. And it doesn't help anymore. It creates a duplication of costs for two departments taking credit for the same thing and then calculating their unit economics against that instead of what double the cost would be. And so we need to be looking at all the things that we spend to create pipeline. Like it's very rare that marketing actually books meetings. Marketing collects first-party signals that then allow this SDR to book the meeting. And so when you think about that logic, even if you got a demo request, the SDR you needed all the marketing dollars, and the SDR still had to call them and still had to get the meeting. Even if they get the meeting at 10% instead of 1%, they still had to go out and get the meeting. So you have The difference is not inbound and outbound anymore to give credit to SDRs or marketing for sourcing the lead. It just doesn't make it doesn't help anybody. It doesn't help the comp plans. It doesn't help the machine, anything. It should be, we need to get signals that our SDRs follow up with to book meetings, if that's how our factory runs. And then the signals can be first-party signals, historically come from marketing-owned assets, but they're really business assets, or third-party signals that come from data providers that give us signals. And then you're looking at marketing and SDRs as a unit that create the lion's share of your pipeline, not as two individual functions. So the inbound, outbound distinction, the conversations around attribution, sourcing between SDRs and things like that, compensating SDRs differently for an inbound lead versus an outbound lead, all this stuff is just getting in the way of you running a proper manufacturing facility. You can still comp the SDR in meetings, just don't change the comp, whether it's inbound or outbound. Maybe you could start calling it first party or third party to get out of the inbound outbound conversation. I made the example in my post today, but people really need to understand what happens here is that when you take a go-to-market unit and then you break it into a function which theoretically owns one part of the process, and then break it into sub-functions that own a sub-part of one process, and then that sub-part, like demand gen, is trying to make an ROI calculation on the demand gen budget against all the website pipeline and create some figure around their ROI, and they don't have visibility into how much the SDRs cost, how much the sales team costs, how much it costs us to renew customers, or what our gross revenue retention is, or our CSAM costs, or our operation costs, or our leadership costs, or our events costs, or our marketing headcount costs, and they don't include any of that stuff in their calculation to calculate their ROI. And so they think in their little thing, we're doing good because we spent only this much on ads, then we took credit for every single website deal that came in. But when you look at it across the whole thing, you realize, wow, this is really, really, really inefficient. And so if we are calculating unit economics, it cannot be done in a sub-department, and it cannot be done at a department level either. It needs to be run through finance in a unified view. When Tom Wentworth came on the podcast a couple of weeks ago, for those that came, they have an FP&A person assigned to marketing that's probably helping them calculate cost per qualified opportunity and things like that as their measure of unit economics. But it's still coming from finance. I think that's really important. If in marketing, if you want to try to assess your unit economics, then involving finance to understand how it impacts the rest of the system, I think is a critical part of making these accurate calculations and properly assessing the efficiency of your marketing. And then I think I had one more topic. We'll see. Otherwise, maybe there's some questions. Nope.
We have a question. We have a question from Stacy, who I'm going to. She can't come off mute, so I'm going to read for her. But would love to hear Chris's thoughts on go-to-market pros and cons through direct versus reseller or distributor channels. So a big why behind this question is that they are sustainably growing and scaling both direct and distribution channels. But their software development and internal resources are pretty lean. So they're getting pressure from their board to pick a business strategy so that they can better prioritize the roadmap and resources. So they're getting pressure to pick one or the other. Any thoughts on pros and cons for that?
All the challenges that come up in these questions in B2B have already played themselves out for a decade in B2C companies. It's already done. It's the same thing as Nike selling through Foot Locker and their own stores and their e-commerce. It's the same thing. It's called omni-channel retail or omni-channel distribution in B2C companies. And when you do that, you create channel conflict, because then Nike's e-commerce store is competing with their physical stores, is competing with their distributors to get that sale. It's the exact same thing. And at that level, when you play at that high level, it is an interoperability challenge, and you're trying to optimize the interoperability, not kill one of them that's working. And Nike went back on it. In 2020, they made the decision, we're getting out of distribution. We're going to own our own e-com. We're going to have all of our first party data. We're going to sell through our stores. and we're going to cut out distribution and keep the margin and own the customer experience and own the customer data. And they walked back from it. Like the CEO walked back from it a couple weeks ago and said that cutting out distribution was a bad move. And so, and like, yeah, taking an existing flow of revenue that's delivering you whatever it is, it could be 500K a year. Maybe it's not meaningful to a big company, but like for a big company, you have your direct channel doing 80 million, your partner channel doing 20 million, or your indirect channel doing 20 million. And what are you going to do? Say, forget the partner channel. Let's just cut 20 million in revenue and focus on our direct instead. It was a theme in the other thing too, like cutting things that are working almost never is the right strategic decision. Figuring out how to integrate them better together, I think, is a better move. So, and then there's some people that are like, oh, like we want to be 100% partner attached in our deals because Microsoft does it for their massive distribution in one of the biggest companies of the world. And our 100 million ARR company wants to do that, or our 10 million ARR company wants to do that. And like, then you're just giving 20% away every deal. Don't you want to have some flow of direct money where you're not paying a 20% margin to somebody else for doing nothing or doing little? So I get the partner attached narrative can work for HubSpot or Salesforce or Microsoft or AWS, but it's not going to work for your 10 million ARR company. So figure out 100% partner attached when you're a billion ARR.
But they're kind of going back and forth of one option is either staying direct in their biggest markets where that's already working, and then maybe moving distribution only to other markets where they don't have a direct presence. That's something that they're thinking about.
I'm generally an advocate for owning the customer experience and that type of and I've been through companies that used to sell through nationwide distribution and were paying 40% margin in 2017 and cut the distribution agreement and built their own field sales team and went through the financial roadblocks of fixing that over a couple of years where revenue declined and things like that. If you want to make that strategic move, then by all means do it, but it comes at a cost. So, and then I think even if you're like, okay, like let's cut distribution out of all of our primary markets, they're still your primary markets and you're still cutting out a significant channel. And so like, yeah, I'm not sure that strategy actually avoids the pain. So that's something else to consider too.
Super helpful for her. And I get why your board is maybe pressuring to pick one or the other, but I think some of the talking points of don't kill something that's working, or at least you need to quantify that. Like, hey, if we do this amount of money is at risk that we might just not get anymore, right? So that's something that think of there.
A potential way to think about this is to think about the indirect motion or the indirect like acquisition model as filling roles in either one or multiple go-to-market motions. So maybe like for your velocity middle market segment that pays you 35K a year, you want to do that all direct. But when it comes to whether it's a vertical or a motion, maybe in your high touch motion, that having a partner attached to do the onboarding and professional service is actually a great way to have that motion and not have to build that internally. And so thinking about the partner to fill in a specific motion between low touch or no touch, low touch, medium, high touch, or dedicated touch, and fit it into one of those production lines in the revenue factory, I think is one potential, or to verticalize indirect. So you have, either you have an indirect that's going to go out and get you all the top consulting firms. You have an indirect that's going to get you all of the legal and finance sector or whatever, how you split it off. So thinking about distribution, opening up a channel that you either don't want to or can't serve directly.
Love it. She said, thank you so much. That's very interesting, though. Not an option that we've discussed or vetted yet. So very helpful.
Cool.
So thank you for that. And I think we're good to...
Right on, everyone. It's the beginning of August. You can use this time to build some momentum. And then I'm going to take a little break for Labor Day weekend. And then most people are at either Dreamforce, HubSpot, SaaStr. So all their September's out. So you can use this way to, especially for like the early stage ones, use this as a way to spend a couple months to get ahead. And then you can close out the year strong. So that's the strategy we're taking at Paceto. Hope you all use that if you would like. And appreciate you all being here. Great high level discussion. Love the direction that these topics are going and how the group is forming. So thank you all for the people that come here every week or try to make it when you can. Appreciate your input and everything like that. And we'll be back again next Tuesday and every Tuesday after that. So catch y'all soon. See ya.